Hello, everyone. This is Jim Hiles at First Capital and Go Plan 101. Today is Monday, August the 23rd. Just a quick recap on the week and a couple thoughts going forward. Last week took a little step back as most of the indices were down as of Friday. Not significant, but certainly impacted by the economically sensitive cyclical companies like banks and energy, and certainly the fears over the rising number of COVID-19 infections. And this certainly is concerning. But looking through it is what we're trying to do as we look ahead in the markets. You look at what's going on with the Fed. Guys, we know tapering is going to happen. We know interest rates are going to go up. So it seems the market is just hanging on their every word, looking for reasons to sell. So I don't think we're going to see an imminent hike here in the next couple of months. We'll see what the Zoom meeting in Jackson's all about as they convene this week. Oil's down a little bit, $62 a barrel. That's a supply-demand issue. And the mess in Afghanistan, I don't know what to say there other than it's a mess. And hopefully we can resurrect our image around the globe because it hasn't been done as well as I'd like to see it done. When you look at the total returns of the year, we're still having a good year, and there's reasons for this. NASDAQ is up almost 15, S&P 19. Internationals are lagging. They have been lagging. They lagged last year. They continue to lag this year. Doesn't necessarily mean to say we shouldn't own them because they are a lot less expensive price-wise than we are in their stock market. So a lot of good reasons to be there. However, one of the main players is China, and they've had a little bit of a drawdown here in the last couple of months. They're kind of resetting their economy again. When you look at the heat map, you can see small caps, got beat up the most, which is the riskier part of the investment market, which leads us to believe that there is risk out here. We're continually starting to see more and more reasons to be aware of volatility is likely to increase. We're likely to see corrective action in the stock market. It means it goes down, but that's okay. It's kind of the part of it because the underlying economy is still strong. The returns are very strong, particularly when you look at what's going on in the large cap and mid cap value area. And that's been an area we played a little bit more on than last year. You look at the sectors, quick view here. Real estate this year still continues to be the leader. Technology is at 20%, right near the S&P. But you'll see some surprises in here as well, with communication services up at 25 year to date. I don't think anyone could have predicted that real estate would have been up 30%, but it's important to pay attention to where these sectors are going. The chart of the week is basically saying, hey, employment, which is a significant driver of sentiment, has rebounded significantly, and there probably, from what I can tell from talking to people out there, there's a lot of work to be had. There may not be enough workers, and that could be a problem. We'll see again what happens in the next month or so. Risk on, risk off. We are long-term risk on. The market is still strong enough to be long-term risk on. I know it's Monday. The markets are up at least as of about noon on Monday. And there's a reason for this is because the short-term indicators might be saying that risk is here and or we should be expecting some sort of drawdown in the stock or equity markets, but it is also telling us that underlying long-term trend is still long and good, and we should stay that way. It's important to know where you are. This is our international opportunity portfolio, and I'm only showing this to you because to give you a feel for one of the things that we are doing and how we're allocating in the international space. I mentioned earlier, it's probably less expensive based on a PE basis to invest overseas. We tend to get a little myopic in being U.S. citizens to focus on the U.S. markets, and we still think they should have the majority of the portfolio. However, a certain percentage of the portfolio should be diversified in international companies. International companies are a lot different than international countries, so keep that in mind. We're not investing in the country, we're investing in the company, which happens to be located in the country. It is subject to currency effects as well. They tend to be a little bit riskier than U.S. stocks over time. Year to date, this portfolio of our international stocks, for example, is up about 11%. Last year, they're up about 33%. It isn't necessarily diversified outside the U.S. holistically. As a matter of fact, 21% is in what they call North America, which is Canada and the United States. And then you also see that 30% is in Europe, the developed markets, versus the emerging markets in Europe. And you see a large portion of it in Japan, and then we certainly have some in the Far East. So that's what the international portfolio looks like. I just wanted to touch on that today. If you have any questions regarding allocations or diversification, how important it is, please feel free to give me a call. Anyway, thoughts of the week will close with the fact that we believe the job indicators are looking more positive than ever off that steep drawdown from last year. We continue to see this improving. We're looking at jobs awful closely because that does drive inflation as the number one indicator. And it looks like the transitory inflation comments by the Fed appear to be true so far, as the job market is strong, but wage inflation has really not picked up yet. Wage inflation is really one of the true indicators of what could be happening on the inflation front. But things look pretty good. So stay tuned. Talk to you soon. Thanks.